And now we will start with the keynote. I'm really proud and I'm really excited to announce Jonathan, CEO of Coinometrics. And yeah, Jonathan, now you can taking the stage. Give him a warm welcome in Cologne. Yeah.
Okay, I'm going to try and juggle two different devices, and I'll probably start moving the slides with my microphone if I get confused. Just a quick introduction for those that know Coinometrics. We're a data services or data analytics company for Bitcoin. We, as you will see in this presentation, we track everything from messages sent around the peer-to-peer network to market exchange data, providing risk management tools to Bitcoin businesses, and reporting tools and any kind of market analysis that you would need. So I first got into Bitcoin because there were no economists looking at Bitcoin. And I thought that the real innovation behind Bitcoin was providing adequate incentives to voluntary participants to process transactions and come together and agree on a system of value transfer. It's still evolving, and that's why we look very closely at the current health of the network. So I'm going to talk a little bit about the state of mining. I'm going to talk a little bit about how messages are passed around the network and what implications that has for the Bitcoin miners and for transaction fees in general. And I'm going to talk a little bit about the state of Bitcoin exchanges. So without further ado, I'm going to start right at the beginning. I'm going to talk about the founder, Satoshi Nakamoto. And this is what he left us as a signal of what he was doing right at the beginning of Bitcoin. So in the beginning, this is quite difficult to read with colors, but basically what he was the only miner. And he started his Bitcoin client on the 3rd of January 2009. And what happened in his software was every time the Bitcoin mining software basically goes through numbers called the nonce, trying to solve a cryptographic puzzle. And once we've found a valid solution, you then have the right to publish a block to the network. That's done to basically ensure the security of the network. And what was interesting was he left a data pattern behind that allows us to identify exactly how many blocks he mined. So it's really difficult to see on this graph. Perhaps we'll move on. But as you can see, all of these lines are different colors, and the grid, we can basically pick out who was mining depending on this data trail that was left behind. So these are actually Satoshi's blocks. We estimate he has about 1 million coins. So one measure that we look at Coinometrics is the concentration of wealth on the Bitcoin network and how that evolves over time. And if you looked back around the time that Mt. Gox fell over, you could see there was a very high concentration of Bitcoins in large addresses. And that provides risk in terms of the amount of market power that certain participants have, but also security risks for thefts. So this is just really showing that Satoshi, the original founder, had a lot of control over the network. He decided how much he was going to mine, when he was going to mine it, and he went and stepped down his hash rate, not only in absolute terms, but also proportionally to the network. So you can see he went from 100 right at this top bit, chose to stay at about 75, then dropped it again, and then dropped it again. So he had plans for how the network was going to evolve, and eventually it actually did take off. So at Coinometrics, we look back deep into the entire history of Bitcoin, because it does contain useful information about what are the current risks, what are the threats to the ecosystem. And this is one thing that was identified by 2 academics at Cornell, an idea called selfish mining. And what that basically means is you run your program trying to find a valid solution to the cryptographic puzzle, and you withhold the block from the network and already start working on the next block in the chain. So you try and create a private blockchain that overtakes the pace at which the main blockchain is being created, and that allows you to do something called selfish mining, which raises your expected reward, but also would enable you to double spend very easily. So what we do here is people think that 51% is the only way that you can essentially do this strategy, but it's not, and we should be worried about any big mining company or single point that has over about 25%, because they will find it profitable to use this strategy. So what we do is we have a look at both how quickly blocks are coming out, and we look at essentially what you can work out the probability that with different shares of the network, what is the probability that you can create this private chain and overtake the main chain. So if say, for example, okay, there's no pool at the moment with 34% of the network, everyone's around 25% of the network, but Ghash was recently at about 34% of the network, and with a 25% probability, they could rewind 6 confirmations. So for exchanges in the room that accept 6 confirmation transactions, this is slightly worrying if someone could hack into Ghash's servers and with 25% probability be able to rewind the blockchain 6 blocks. And this is a very real threat. So what we want to do is, what we want to say is that we should be tracking these risks. We need to be, as businesses, taking responsibility for the underlying state of the Bitcoin network, not just building interesting products on the top. So this is kind of showing our historical analysis of how close we've been at different points in time to the 50% mark. It's not super clear on the screen, but if you use this measure, there are some observations that are around the 50% mark, and that's really dangerous for the Bitcoin network. So another thing, we have identified over 50% of all the blocks that have ever been broadcast on the Bitcoin network, and this is the current share of the hash rate. So we use about 40,000 generation addresses that we know about to identify the different mining pools. We also look at how they sign the Coinbase transactions, and this week, this is a weekly estimate of the hash rate. And this week, Discus Fish actually overtook Ghash as the largest mining pool in Bitcoin. Ghash's mining hash rate dropped about 10 petahash, and there's now a new large unknown chunk, which is in here, which is 10 petahash, which we don't know who that is yet. It's really important to understand these dynamics because, as I said, people with large amounts of hashing power can be very, very dangerous for the Bitcoin network. So we also have a look at the pool's release data on the density or the distribution of hash rate even within their pool, to try and identify large clumps of hash rate to see what they can do. This over here is the Ghash distribution of hash rate. You can see that a lot of the hash rate comes in this top band, and some of this is now separate from Ghash. So one thing that has happened on the Bitcoin network is that the hash rate in absolute terms has risen dramatically. This is even on log scale, so this is really explosive growth, and people look to that as the security measure. I would say it's probably not the best security measure, but it's still very significant and could be interesting to build applications based on the amount of hash rate that Bitcoin has. So that's enough for Bitcoin mining, and we can talk a bit more about that later. This is how information spreads around the Bitcoin network, influencing how blocks are found on the network. So in a peer-to-peer network, we don't have the full view of the network. You only have as much knowledge as the peers that you're connected to. And messages are being passed around and individually validated at every node, and that can lead to large delays. So this is looking at the, we know how often blocks should come out. It follows an exponential distribution, and we can have a look and see that over here in the beginning phase, so This would be if two blocks came out at the same time on the far left, and then this is very shortly after the creation of one block, another block gets found, and every bin should be the same height. We've scaled it so that every bin should be the same height, and you can see that there's blocks missing at the beginning because information takes a while to spread around the network. And what we say is that we need to figure out exactly and model how information spreads around the network, because it tells you what are the risks that transactions get double spent, what are the costs associated with processing transactions. For a miner including a transaction, it actually doesn't cost anything in terms of the computational power that they expend checking that the transaction is valid. It actually, the marginal cost of a Bitcoin transaction for a mine is simply the added time that it puts on their block propagating around the Bitcoin network. Because what that does is it increases the probability that another miner in the network will broadcast a different block, and that will be accepted by the network first. So what we've done here is we've said, taking our sample, how many, this is block size in kilobytes, but you can do it with number of transactions. It almost works equally well. And we want to fit a distribution to understand how big blocks go and how long they take to propagate around the network. So I ran some numbers. People are talking a lot about this because transaction fees are going to start floating in Bitcoin. So right now they're sort of hard-coded, or there's some guidance from the core devs, but they're going to start floating in the next iteration of the client, most likely. And this is me just saying that what happens if we're doing 10,000 transactions in a block. So right now there's maybe about 1,000, maybe 700 transactions in a block. But what happens if we go 10,000 in a block? What are the incentives for miners to include transactions if they're left at the current level of 0.001? And you can see that their expected reward falls down to about 23 Bitcoins a block, whereas they should be, at least, if they don't include any transactions, they should be 25 Bitcoins a block, given they find one. So that's the block reward. So the block reward is 25 Bitcoins a block. If they include 10,000 transactions, because they're going to have more of their blocks are going to be discarded by the network, in expectation they're only making 23. So that's something that indicates that the marginal cost of including a Bitcoin transaction might be, will determine the lower bound for transaction fees in the future. What we need to do is either figure out other ways to incentivize miners, or find more efficient ways of sending block information around the network. And there are a few suggestions, but they come with their trade-offs. So really what we do at Coinometrics is we take this level of analysis and apply it and say, we can monitor transactions in real time and provide risk scores for businesses taking transactions on, estimating the time of confirmation, protecting against double spending. And if anyone wants a demo of that, I'm more than happy to show them. We also do volatility modeling and think about currency risk that businesses take on when they hold Bitcoins and have fiat obligations. So the current state of the Bitcoin network, we've seen 2 flash crashes in recent time, and this was at Bitfinex 2 weeks ago. You can see that it's pretty difficult to read at the timescale. This is a really small timescale, but what happened was margin traders were essentially stopped out of their positions, and you saw the price fall pretty significantly in a short time before recovering back. So this market is still maturing. The exchanges are offering traders the opportunity to borrow both Bitcoin and dollars to trade on their exchanges, but haven't really worked out their risk management tools properly. We're estimating the volatility, which determines what margins you should be offering, and trying to ensure that flash crashes don't happen, and that no one is exposed to too much counterparty risk. So we also looked at the flash crash on BTCE. They implement a kind of circuit breaker. So you can see that there's, after 150 trades, there's a gap between these dots where the matching engine is not functioning for about 30 seconds. And essentially, we want to say also that maybe this needed to be a little bit longer intervals because the price still managed to tank and the buy orders didn't come back in a timely manner to ensure that the market didn't crash down to $309 a Bitcoin. So really, you can see this is the tool that allows you to do the margining. We look at how much 1 day ahead we expect the Bitcoin price with a certain confidence to be within that band, which gives you the return on a daily basis. So, and based on how volatile the asset is being, the more you should require your traders to post margin or collateral in order to lend to them. So you can't avoid massive price movements like this, but you can certainly ensure that people don't lose money on your exchange. So that's really where I see Bitcoin at the moment. There's a lot of risks associated with transacting with a new payment network. We've had a kind of initial phase where the companies are well capitalized enough. There's not actually enough exposure or incentive for people to manipulate the network. I think we're now turning that corner and there's a lot of value at stake, and we're building risk management tools to allow businesses to accept Bitcoin like they would other payment networks. And we look forward to working with the community to really drive this ecosystem forward to make data-driven decisions. So I'm around for the conference today. I'm based in London. I have a co-founder in Berlin. Yeah, does anyone have any questions?
So first of all, thank you, Jonathan. Yeah, there was one question over here, Bastian.
Yeah, actually, it's two. If that is fine with both of you. Yeah, my name is Sebastian Brandt. I'm living in Munich, but I'm also working together with a VC in London, and so we already know each other. It's nice to meet you, Jonathan. Yeah, I've actually just for everybody. I was supposed to give a presentation yesterday, but due to some traffic problems, I couldn't attend. So sorry for that. Just two questions. The first one is the volatility. You had a very nice graph, and I was wondering if you see any patterns, like volatility is in general higher in the morning hours or in the evening hours, say London time, or it's higher on Mondays and low on Fridays or something like that. So it would be interesting to know something about that, to have an analysis on that. And just the second question is on this trade-off curve between the number of transactions you take into your block and the speed of propagating. And I'm a bit surprised that this is really linear. I would expect this curve, this pattern to be rather like a curve with a sweet spot in the middle. Yeah, and I'm just wondering, would be interested to know why it's actually linear.
Sure. So with the volatility stuff, we really at the moment do 1 day forecasts, which means we take daily data and forecast 1 day ahead. We see a general reduction in volatility over a long stretch. So this is, for those that can't read the scale, this is from the beginning of 2014 down to August, so about 8 months. We see, but volatility comes in generally clusters. So, I mean, if you look at the graph over a very long period, you'll see there's periods of very low volatility and periods of very high volatility. One thing that I should caveat with this type of model is that you can't predict large price movements a day before. So if something does happen in the Bitcoin ecosystem, I can't say a day before that it's going to happen. But I can tell you how to react to that as it's happening. So as for very granular volatility measures, we haven't done that yet. We do have that data, and we are probably going to do an hourly forecast. I'm not sure how much information is going to be contained within it. That's why I think the daily volatility we chose is the first most applicable measure for the beginning. As for why these lines are linear, they're they're actually not quite linear, but yeah. So what they do is the probability. How to explain this properly? So really, what happens is that you calculate an expected delay, and that's going to have some set probability, and so yeah, the model that actually generates it is really non-linear. It's just like the scale at which these graphs are drawn are too small to capture that. But essentially, you work out the probability that the block gets lost, which is a non-linear function. It's still pretty much increasing, but it looks more linear than it actually is. If you go outwards, way over 10,000, things start to go really bad. Sorry.
Yeah, thank you.
Are there more questions? Yes, please introduce yourself and then the question.
Yeah, I'm Niels Kerstold from BitPay. We're located in Amsterdam now, and we're trying to get merchants all over Europe to accept Bitcoin as form of payment. I had a question about the 10% in the hash rate. There's a group that has at least 10% of the hash rate now, and it's an unknown party.
It's all the unknowns. So we clump together. We don't know, if I don't know who someone is, they've got 10 petahash, which is about 8% of the network.
Okay. But you don't know, are you doing research on who they are? Do you expect something like a Chinese group of investors or whatever? I don't know.
Yeah, I'm not going to say like in public who we think it is, but essentially they have one address that they're sending all the money to, which we are tracking, and we'll see where they spend their money and if they reveal who they are through their spending patterns.
Okay, so okay. Thanks.
I can talk to you afterwards, yeah.
Okay, thank you.
Okay, really interesting. Are there more questions? Yes, over there.
Hello, my name is Daniel. I'm with Skrill, a payment provider from London. And I'm just wondering, you said that there's a Japanese founder. Now, my question is, does this person really exist who wrote this Bitcoin code? Is it just a legend about it? Is there any confirmation about it? Have you ever seen that guy? And yeah, well, because I think it's really important to know who exactly set it up in the first place in order to know if you can trust the system itself.
So I would say the following. I didn't say he was Japanese. The founder was likely one entity because this is like a very deliberate plan. And I think this for us is the first bit of evidence that Satoshi is an entity that had a lot of control over how he interacted with the network. The original code was very messy, but he and has been largely rewritten. So I think you trust that people who are running the code and who are looking at the code actually have implemented good code. In terms of wealth concentration, yes, it's a large risk. We are monitoring all of his coins to see if they start moving and can provide that as a service if that is of interest. His or her coins, or their coins, or its coins. This does reveal their identity, but it does start to paint a picture about what the original intentions were, how much wealth concentration there is. But I would say in order to trust the system, and that's the code, that's independent of the original founder.
Okay, are there more questions? Yeah, one more.
Hello, my name is Eugen Salgozan. I live here in Aachen, Germany, and I'm here as a representative for a new coin that this name is Veracoin. It's a proof of stake coin. And my question is, you talk about mining, and how do you predict the energy consumption in the next years of that upcoming mining, because it's getting large, I think.
Yeah, so we expect that the network hash rate will continue to increase. It slowed somewhat just because of the price of Bitcoin, but it's probably going to be somewhere north of 600 petahash by the end of the year. The proof of stake coins are very interesting to me as an economist and someone who thinks about incentives. But I think there could be more interest in them if that does take hold. There's also efficiency gains and people locating in more energy-friendly environments with renewable energy and stuff like that that might make it less of an issue than people actually think. But yeah, I agree, it's a big issue.
Okay, one more question.
Hey, my name is Andreas. I'm from Wiesbaden and I'm a student. I was wondering which factors are you including in your volatility analysis? Just the size of the Bitcoin hash and the time it takes to solve a block, or are you taking other factors into the analysis too?
So the volatility is just market data. So that's just using daily returns. So today's price minus yesterday's price as a percentage, and looking at using pretty industry standard volatility forecast models that they use in banks to do volatility forecasts. But the scoring in terms of probability of double spends and detecting live double spends is, yeah, we're currently developing it. It's time between blocks, it's size of transaction, it's taking into account mining pools inclusion policy, and stuff like that.
All right, thank you.
Okay, thank you, Jonathan. One more question? That's the last one. Okay, last one.
Hello, my name is Erke Alama, United Miners. And my question is pretty simple. Did you analyze that too, how big part of day trades are made by trading bots?
No, we haven't done that analysis yet. It would be a little bit difficult to get that information from the exchanges because they don't provide trader ID, anonymized trader IDs on their exchanges.
The question comes because of that something like 2 days ago, there was one wrong triggered bot
on BTCE.
Yeah.
Yeah. Yeah, unfortunately, to really analyze that crash or the increase in volume, it wasn't really a crash, but $30 down on BTCE. You'd have to have released next to it individual trades with what trader ID made that trade. And the API from BTCE does not include that information. So unfortunately, I can't really do anything until BTCE, if you're listening, please provide us with that data.
Okay, thank you.
Okay, thank you, Jonathan.